recent IRS challenges to Grantor Retained Annuity Trusts. That's the subject of today's ACTEC Trust and Estate Talk.
Welcome to ACTEC Trust and Estate Talk from the American College of Trust and Estate Counsel, a professional society of peer-elected trust and estate lawyers in the United States and around the globe. This series offers professionals best practice advice, insights, and commentary on subjects that affect our profession and clients. And now, our ACTEC Fellow host with today's topic.
This is Travis Hayes, ACTEC Fellow from Naples, Florida. Grantor Retained Annuity Trusts, also known as GRATs, are commonly used to potentially minimize taxes on large financial gifts to family members. There are two separate significant IRS challenges to GRATs in the context of ongoing merger negotiations that have garnered considerable attention going back to 2019. ACTEC Fellow Kevin Matz of New York City will explain the significance of these cases in the IRS rulings. Welcome, Kevin.
Thank you, Travis. So we have essentially here a tale of two GRATs in the context of ongoing merger negotiations. As Travis has mentioned, there are right now bubbling up two separate significant IRS challenges to GRATs in the context of ongoing merger negotiations that have generated considerable attention. And this is going back to 2019. First, we have, in a case that is now settled favorably to the taxpayer, we have a case in which the IRS withdrew its previous position in Chief Counsel Advice 2019-39002, that it rejected the use of standard methodology in valuing publicly traded stock transferred to a GRAT that failed to take into account pending merger discussions. The resolution of that was in Batty versus Commissioner. That is a stipulated decision that was entered on June 17, 2022. However, against that, we still have present bubbling up in the tax court. We don't know exactly where it is these days, but we'll probably hear from it before too long. A separate resolution of a CCA or possible resolution of a CCA that applies the so-called Atkinson rationale, which is another way for saying blowing up the GRAT is not qualifying, being disqualified, that also involved evaluation in connection with anticipated merger. And that was in CCA 2021-52018. And as mentioned, that is now a pending case. So turning to the first one, the 2019 CCA that is now settled, again, that's 2019-3902, the Chief Counsel Office of the IRS considered a situation in which a co-founder and chairman of a company whose stock was traded on the New York Stock Exchange contributed shares of the company's common stock to a 2-year zeroed-out GRAT. Now, what that means is essentially the GRAT annuity was set to roughly equal the value of the shares transferred to the GRAT, taking into account the Section 7520 rate in effect at the time of the GRAT's inception. So the donor's gift tax return valued the shares based on the mean between the high and low New York Stock Exchange prices on the date of contribution. These prices did not take into account ongoing merger negotiations, which did ultimately come to fruition about 7 months later. Very significantly, however, it would have been a violation of the federal securities laws for the donor to sell the stock at that time. The IRS's position was that the stock should have been valued roughly 50% higher than what was reported on the gift tax return, and that the difference, the delta, approximately $18 million, should be considered a taxable gift, notwithstanding that the GRAT trust instrument contains standard provisions for a formula revaluation of the annuity amount based on amounts as finally determined for federal gift tax purposes. This matter, as I mentioned, was litigated in the tax court in Batty versus Commissioner. And the crux of the taxpayer's argument was, as you would suspect, that the GRAT valuation adjustment clause applies to prevent any gift tax whatsoever. Now, as set forth in the taxpayer's brief, with respect to the willing buyer, willing seller analysis, the IRS provided no explanation whatsoever of how the hypothetical buyer might learn of a closely guarded merger negotiation, nor did the IRS address the fact that to trade a non-public information received from insiders would be illegal. Now, the IRS's CCA here cited an exception to the mean between the high and low method of valuing publicly traded securities that's set forth in Regulation 25.2512-2E. That regulation begins as follows, quote, in cases in which it is established that the value per bond or share of any security determined on the basis of the selling or bid and ask prices does not represent the fair market value thereof, then some reasonable modification of the value determined on that basis or other relevant facts and elements of value shall be considered in determining fair market value. Now, the CCA cited this regulation, concluding that a reasonably informed hypothetical buyer would have knowledge of the pending merger and that to ignore the circumstances of the pending merger would undermine the basic tenets of fair market value and yield a baseless valuation. If you look at the regulation, however, it doesn't say that. The regulation mentions several situations in which the exception might be applied, including fewer sporadic sales, a very large block of stock being valued that could not be liquidated in a reasonable time without depressing the market, or a block representing the controlling interest. None of these situations described in the regulations apply to the Batty facts. In addition, the merger in Batty was not practically certain to occur, and in fact did not occur until more than 7 months after contribution of the stock to the GRAT. Accordingly, the IRS's attempt to rely in that CCA on the Ferguson versus Commissioner case, which incidentally is an anticipatory assignment of income case, was factually misplaced. Moreover, the taxpayer's brief on its memorandum moving for summary judgment in the Batty case pointed out that the IRS position that non-public information should be considered in valuing publicly traded stock would create an administrative nightmare of epic proportions for both taxpayers and the IRS, as unworkable for a gift by an insider under the federal securities laws. Now, in Batty, the IRS's primary position was not the draconian position that later 2021 CCA that we'll talk about in a second of disqualification. Rather, the IRS's notice deficiency took the position that the annuity payments would not be adjusted, notwithstanding the GRAT trust instrument requirements calling for such adjustments, so that the difference between the IRS's determined value of the contributed stock and the value of the contribution reported on the gift tax return was a gift. Now, the IRS did say in the alternative, they said, well, maybe you don't have a qualified interest, but they didn't focus on that. That was a backup argument. The service apparently saw the taxpayer's very strong brief and ultimately conceded. They fully conceded, and a stipulated decision was entered in the Batty case, taxpayer's favor, taxpayer victory. That's GRAT number one, but I said a tale of two GRATs, right? So what about the second one? And that's at 2021 CCA, 52018 against CCA 52018. The facts were not good for the taxpayer. The donor was the founder of a very successful company that, through an investment advisory firm, solicited offers for merger and received 5 such offers. 3 days after receiving the 5 separate offers for merger, the donor then created a 2-year Granter Retained Annuity Trust, 2-year GRAT, the terms of which satisfied Section 2702 in the Treasury regulations. Donor went ahead and funded the GRAT with shares of the company. However, the value of the shares, we're not talking publicly traded stock here, we're talking about privately owned stock. The value of the shares is determined based upon an appraisal of the company as of a date that was approximately 7 months prior to the transfer to the GRAT. The appraisal, which was obtained in order to satisfy the requirements for non-qualified deferred compensation plans under Section 409A of the Internal Revenue Code, valued the shares at a very low price that was much, much lower than the prices that reflected the merger offers. So stopping right there, the facts are not good. They get worse. So subsequently, very soon thereafter, the donor gifted company shares to a separate charitable remainder trust. And in contrast, valued those shares for charitable deduction purposes at a subsequent tender offer price that is approximately 3 times greater than the Section 409A appraisal price from the prior year that was used to establish the value of the GRAT, even though it was the same roughly the same time frame. Now, when asked to explain the use of the outdated appraisal as of December 31 of the prior year to value the transfer of the shares of the GRAT, compared to the use of the new appraisal to value the transfer to charity, the company that conducted the appraisal stated only that, well, the appraisal used for the GRAT transfer was about 7 months old, and business operations had not materially changed during the 6 or 7 month period. However, for the charitable gift, under the rules of the Form 8283, in order to substantiate a charitable deduction greater than $5,000, a qualified appraisal must be completed. Because of this requirement, an appraisal was completed for the donations accompanied to the various charities. Well, the IRS was not amused, needless to say. And its analysis, the IRS started with a willing buyer, willing seller test, but then turned rapidly to consider, do you have a valid GRAT at all? It considered, what's the meaning of a qualified annuity interest in a GRAT for purposes of Treasury Regulation Section 25.2702, and noted that Section 25.2702-3D1 provides that to be a qualified annuity interest, the interest must meet the definition of and function exclusively as a qualified interest from the creation of the trust. Then the IRS cited the case of Atkinson versus Commissioner, which is a tax court decision from 2000 affirmed by the 11th Circuit Court of Appeals in 2002, for the proposition that in the somewhat parallel context of a charitable remainder trust, and granted, we're dealing with a GRAT here, not a charitable remainder trust, but the IRS is importing the analysis to stand for the proposition that the failure of the trust in Atkinson to function as a charitable remainder trust in its administration caused that trust to be disqualified as a charitable remainder trust from the get-go, from inception. Now, in that Atkinson case, the donor had created a charitable remainder annuity trust, but no payments were actually made from that trust to the donor during the 2-year period between the creation of the trust and the donor's death. The IRS here, the CCA, argued that this caused the charitable remainder trust in Atkinson, or actually the IRS back at Atkinson argued that it just caused it to be an invalid charitable remainder trust from its creation. And the court agreed with it. The tax court agreed with it because the trust failed to operate in accordance with its terms. Now, applying this analysis, importing this analysis to the facts before it, the IRS and the CCA found the reasoning in the Atkinson case to be analogous and disqualified the GRAT due to the trust's perceived failure to function as a GRAT from inception. Basically, it comes down to the IRS was extremely disturbed by the taxpayers' failure to consider the facts and circumstances of the pending merger in valuing the corporate shares that were transferred to the GRAT. According to the IRS and CCA, indeed, ignoring the facts and circumstances of the pending merger undermines the basic tenets of fair market value and yields a baseless valuation, and thereby casts more than just doubt upon the bona fides of the transfers to the GRAT. The fact that the GRAT trust instrument, in accordance with the code treasury regulations applicable to GRAT, included a built-in revaluation clause to revalue the qualified annuity interest in the event of the IRS adjustment was not enough, according to the service, to save the day. To quote the service, just that they really let off steam at the end. The operational effect of deliberately using an undervalued appraisal is to artificially depress the required annual annuity. Thus, in the present case, according to the IRS and CCA, the artificial annuity to be paid was less than 34 cents on the dollar instead of the required amount, allowing the trustee to hold back tens of millions of dollars. The cascading effect produced a windfall to the remainder. Accordingly, because of this operational failure, donor did not retain a qualified annuity interest under Section 2702 C. Atkinson. Big thud. Ouch. That really is painful for the taxpayer. Well, there you have it. A tale of two GRATs with securities in the merger context, and this second case, the second CCA, is still unresolved. Thank you.
Thank you, Kevin, for updating us on recent developments regarding IRS challenges to GRATs.
Thank you for listening to this episode of ACTEC Trust and Estate Talk, the podcast series about wealth planning matters from the American College of Trust and Estate Counsel. To find an ACTEC lawyer near you, visit actec.org. tec.org. Please subscribe to this series and leave us a rating or a review.